Yes, good morning. Today, for those who haven't met, I'd like to introduce Clint Abraham. Clint is essentially a portfolio investment manager at Morningstar Investments for Australia. Before we jump in, I might just do the general advice warning. Essentially, the discussion we're having today is that of general advice, so please don't act on this. If there is elements of this advice discussion which concern you, which you need to speak about, then please call us directly and we can talk about it in an advice sense. So today I've asked Clint to come on board and have a chat with us, and good to see you back in the office there too, Clint, in Sydney. We're going to be talking about the rising risks associated with complacency. So I might hand over and do you have some views on this, Clint?
Of course, thanks, Murray. Good morning and hi everyone listening. I think it's a really interesting time in markets because if we think about what happened in 2020, obviously financial markets and indeed our daily lives were characterised by the coronavirus outbreak and efforts to keep that in check and obviously keep our population healthy. Now, if we have a think about some of the key events outside of that occurred in 2020, we had obviously the US presidential election. Brexit was very much front and centre for people as well. And now as we approach 2021, many of those risks that we had in 2020, they feel like they're in the rear vision mirror now. We know the outcome of the US presidential election. The UK is formally divorced from the European Union. And of course, we have multiple vaccines for coronavirus in various stages of rollout at the moment. And so it actually feels like a pretty good time to invest. But the concern that we would have at the moment is that investors, as you touched on earlier, perhaps starting to get a little bit complacent. And just because you can't see risk, or it feels like the headline risks at least have dissipated, it doesn't mean that there's risk out there. And so when we think about what may come along, to influence investor sentiment over the next little while, there is the chance that there is some of these risks might come to fruition. For example, we're in the stage now where we're rolling out the COVID vaccine. We don't know how effective that's ultimately going to be in terms of its reach in the population. We don't know what the vaccine will look like and how it will be able to accommodate the various strains that are emerging. But even if we look at things like the US presidential election, yes, the Democrats have won, but it's still unclear how much of Biden's policy, and some of those policies, involve very big numbers. It's unclear around how much of his policies are going to be able to get through. And even if we look at something like Brexit, yes, it's happened, but there's still a lot of uncertainty around what it ultimately means for the UK economy in particular.
Which is interesting, Clint, because the people are buoyed by the fact we've got very low interest rates. Things seem to be getting easier in that respect. There's a lot more rising merger acquisition activity. Certainly asset prices, including property, as we can see here in Australia, has moved to the fore. Yeah. What are your views on what are Morningstar doing to mitigate what I would suggest is probably the rising risks?
I think that's a fair point, because the way that we approach this situation, in the same way that we approach when the COVID pandemic was really taking hold and understandably inspiring a lot of fear and uncertainty in investor thoughts, the way that we approach these situations is through what our valuation analysis tells us. And when we apply that framework to the current set of events, and we're really interested here in understanding what cash flows are we going to get from assets, how might those cash flows grow, and what is the right price to pay for those cash flows. In many cases, markets are once again starting to get expensive. And so there's very little room, in certain assets anyway, for error should there be some delays in the economic recovery that we're seeing at the moment. And so our portfolio positioning is really to continue to favour towards those assets that we think are going to give us an attractive reward, and helping, and obviously we're most interested there in avoiding those assets where we might lose money that we never make back.
Yeah. So where do you see the opportunities in the marketplace now, Clint, from your perspective?
Yeah, funnily enough, they're not too different from where we've seen throughout much of 2020. And so you might recall when the COVID pandemic really took hold, it was those more economically sensitive sectors. Some might refer to them as cyclical sectors because they tend to be leveraged to where we are in the economic cycle. Things like energy, which is the big oil and gas companies predominantly, and financials. So we're talking about global banks. Those two sectors in particular were really heavily sold off throughout the COVID pandemic because people were really concerned around the outlook for global growth. Now, the outlook for growth has improved a little bit, largely as we've seen confirmation of final trials for vaccines and the subsequent rollout. But in many cases, those economically sensitive assets are still, they haven't recovered the losses that they incurred throughout the period of March in particular last year. And so we can still see a lot of value in those assets. So our portfolio positioning, where we're looking at those energy companies and financials, yes, there's they rallied strongly in the final part of the year, but we can still see a lot of opportunity in those assets.
Yeah, which is once again interesting because having watched from the Australian context, seeing the Australian banks, particularly CBA, rally significantly. In the Australian context, seeing Woodside, rally significantly from its lows. And I guess on the international stage, there's obviously greater opportunities there.
Well, there is. I mean, the Australian market only represents about 2% of the global market for shares. But many of the key themes that you're talking about there in terms of seeing global financials rally and global energy companies rally, that has been also what you've seen in Australia as well. But importantly, when we look at those assets, yes, they've run, but they still, in many cases, represent a very attractive opportunity. So there's no need necessarily to trim them. If they're still giving you a good deal, it's okay to hold them. And we really see continued opportunity in the energy space in particular.
Right. Okay. So for people putting new money into the marketplace, the view might be that while markets have certainly improved, there are still opportunities for fair market value in certain sectors across global asset classes. Would
Yes.
that be yep? But at the same time, be cautious.
Yes, I think that's a really good point, because if we look at share markets, and in many cases they've gone on to not only recover their COVID losses, but they've gone on to make new highs. And you might recall at the start of 2020, we were really defensive, and perhaps easily the most defensive we've ever been. And so now we fast forward 12 or 14 months, and we find ourselves in a situation where share markets are once again, in many cases, at quite elevated levels. So, but there's not the same requirement for us to be as defensive this time, because what we saw throughout 2020 was the COVID sell-off really saw some dislocation in pricing, and we can see quite good value in some of these assets. So we're very happily positioned in those assets that we find attractive, holding a bit more cash, holding a bit of cash still in wait for further opportunities. But we're quietly, cautiously optimistic around the range of opportunities that we have to invest in.
Yeah, excellent. Clint, thanks so much for your time today. Really appreciate this quick missive to our clients, and we'll speak probably over the next quarter again. Thank you.
Thank you very much.